Welcome back to the deep dive. We're here again to crack open the source material, give you that essential knowledge shortcut, help you instantly catch up on the big moves driving, well, the modern financial world, especially crypto. Today, wow, we're really wading into something interesting. It's this intersection of high finance, regulation, and, internet culture. We're diving into a pretty strategic play by Grayscale. I mean, they're arguably the biggest institutional name in crypto, right?
Oh, absolutely, the biggest.
And they just pulled off this, like, two-pronged attack on the regulatory front. On one side, they filed a revised S1 for a Dogecoin ETF, yes, Dogecoin. And at the same time, they're pushing for some major changes to their existing Ethereum trust.
It's quite the combination.
Okay, let's unpack this a bit. You've got Wall Street seriously looking at packaging a meme coin for, serious investors. And then they're also fine-tuning the structure for Ether, the second biggest crypto asset out there. This dual strategy, doing both at once, that feels like it says more than just one move alone.
It absolutely does. It's a huge signal, really. Before we get into the weeds of the filings themselves, and believe me, there's some fascinating technical stuff in there we need to pull apart. Let's set the mission for you, the listener. The goal today, it's kind of twofold. First, we really need to grasp the regulatory momentum, How is it even possible that a Dogecoin ETF filing is happening now after the Bitcoin and the Ethereum ETF approvals?
Right. What changed?
Exactly. And second, and this is crucial, we need to dissect the financial engineering that's going on behind the curtain. We'll look at the specific financial implications. What does this mean for DOGE investors who are maybe chasing that speculation? And what about ETH investors who are looking for institutional grade efficiency? These moves together, they really signal a big shift in how institutions might be viewing altcoins. It suggests the ETF world is moving past just Bitcoin and Ethereum.
And where are we getting this from?
Good question. Our foundation here, it's directly from the public filings, the revised S1 for Doge, the NYSE ARCA proposals for the ETH trusts. Plus, research from places like The Block, Masari, regulatory analysis firms, and looking back at how past ETF approvals played out.
Got it. Solid sources. And actually, just quickly before we dive deep, we want to mention something. Your engagement, it really, really matters to us. If you find these deep dives useful, if they save you time wading through dry source docs.
Which they can be.
Definitely. Engaging with this content, subscribing, dropping a comment, just letting us know what you think it do. Genuinely helps support what we do. It boosts our visibility, helps the algorithm notice us, and basically lets us keep making this kind of crypto and Web3 content for you.
Yeah, it makes a huge difference. So thanks in advance if you do that.
Okay, let's jump into section 1. This dual announcement, Grayscale's altcoin strategy.
Right.
Let's get into this Grayscale maneuver. It's such a fascinating study. In contrast, tactically speaking, they're sort of embracing the high-risk, high-reward speculative side.
The Doge.
Exactly. And at the same time, they're doing this detailed, almost unglamorous optimization work.
On Ethereum.
So detail number 1, the Dogecoin ETF. Grayscale has filed a revised S1 with the SEC for it. Now, for anyone listening who maybe isn't deep in the finance weeds, an S1, that's the first registration form you need for new securities, right?
That's the standard paperwork, yeah, the initial declaration.
So when we say it's a revised filing, what does that actually tell us? Grayscale's commitment, I mean. Are they serious?
Oh, it tells you a lot. That's a critical detail. Filing the first S1, that's like saying, we intend to do this. Filing a revised S1, that's persistence. It means the SEC came back with questions or feedback on the first draft, which, let's be honest, for Dogecoin, they absolutely would.
Right. You'd expect that.
And Grayscale didn't just walk away. They took the time, spent the resources, addressed those concerns, tweaked the structure, and they're back again. They are seriously pushing to get this meme coin into a mainstream financial product wrapper. That takes significant legal and compliance effort. It shows they think the market opportunity is big enough to justify battling through some heavy regulatory friction.
Okay, so serious intent on the Doge front. And then the second detail, it feels like the polar opposite. It's about refining, not pioneering. Almost at the same time, NYSE ARCA, that's the exchange where Grayscale Stuff trades, submitted proposals to modify Grayscale's existing Ethereum trusts. What's the goal there? Is it just housekeeping?
It's much more than housekeeping. The goal is very specific: operational and financial perfection. They want to streamline the conversion of these trusts into spot ETFs. So this isn't about launching something new, like with Doge. This is about optimizing an existing product that already holds billions in assets. They're looking at the current structure, remember. These started as closed-end trusts and fixing the known inefficiencies before the final conversion to a spot ETF gets the green light.
What kind of inefficiencies are we talking about?
All sorts. Changes to custody language, how the trust calculates its net asset value, or NAV, basically making it run smoother.
What's fascinating here, like you said, is this two-pronged approach. Chasing the speculative future with DOGE while optimizing the institutional present with ETH. Why do both at once? It seems almost contradictory on the surface.
Well, it actually speaks volumes about their overall market strategy. Grayscale is essentially trying to dominate both ends of the institutional crypto spectrum. Pushing for DOGE suggests they believe, or at least are testing the theory, that regulators might be, more open to altcoin ETFs now. The precedent was set with Bitcoin in 24, Ethereum in 25.
So they think the initial wall of resistance might be lower now.
They're calculating that maybe the really intense regulatory battle is over and they can ride that momentum, see how far it goes, and then simultaneously the ETH trust changes. That's all about avoiding the massive, very public structural problems that haunted the Grayscale Bitcoin Trust, GBTC.
Ah, yes, GBTC. Huge success in gathering assets, but problematic.
Exactly. Hugely successful in AUM, but structurally inefficient. By fixing the Ethereum trusts now, Grayscale is signaling, we learned our lesson. The ETH vehicle will be efficient from day one of conversion. They want to maximize future capital flow into the ETH ETF and minimize any friction for investors. So yeah, pioneering on one front, optimizing on the other, it's quite strategic.
All right, let's spend some real time on Dogecoin now, because this is where things get really interesting, that cultural crossover meeting high finance. If this gets approved, it would be the first U.S.-listed ETF for a meme coin. Forget the hype for a second. What does that actually mean for Dogecoin's status long-term?
It means profound legitimization. I mean, it fundamentally rewrites the narrative around DOGE. It takes it from being this purely decentralized, retail-driven thing, the joke coin, with amazing viral power, and turns it into a product that's officially offered within institutional guardrails.
So it gets a regulatory stamp of approval almost.
Exactly. It offers a level of regulatory endorsement that, frankly, no amount of social media buzz, even from, very influential people, could ever achieve on its own. This makes it accessible not just to the Robinhood crowd, but potentially to actual money managers, wealth advisors, maybe even pension funds, thinking about allocating a tiny slice to high-growth digital assets.
And that cultural piece is so key here, isn't it? We have to remember DOGE already has this massive cultural credibility in its own weird way. We saw how things like Elon Musk's tweets or Tesla announcing Dogecoin adoption fueled those insane price spikes historically. I mean, think back to the whole SNL appearance with Musk. The hype was incredible. It showed this huge, organic, non-financial interest from retail.
Right.
Wall Street isn't stupid. They see that engagement, they see that volume, and they want a regulated way to capture some of that liquidity flow, presumably.
Precisely. Wall Street sees volume, excitement, memes even, and they translate that into potential AUM and fees.
Yeah.
If we look at who benefits, the investor impact, it's kind of distinct groups.
Yeah.
For retail traders, an ETF is massive. It means they can speculate on DOGE through their regular brokerage account, Fidelity, Schwab, whatever.
Lowers the barrier.
Massively lowers the technical barrier. No need for crypto wallets, DEXs, self-custody worries.
Right.
Just buy shares like you buy stock.
Okay, and for institutions?
For institutional interest, it's more about asset allocation. Even if they only put a tiny amount, say limited exposure, maybe 0.5%, into speculative digital assets, that could still generate significant demand for DOGE. How much?
Well, we have to look at the history, the initial inflows into the BTC and ETH ETFs. Bitcoin ETFs pulled in tens of billions in just the first few months.
Okay, DOGE wouldn't be that big, surely.
No, probably not that scale. But imagine if a DOGE ETF captured even, say, a tenth of the appetite we saw for the Ethereum ETFs initially. That level of demand would be absolutely transformative for DOGE's price, its liquidity, its whole market structure.
But, okay, the elephant in the room, volatility. Regulatory skepticism. The SEC's job number one is investor protection, right? Preventing manipulation. How does Grayscale get around the argument that DOGE has little utility, that it's purely driven by speculation and memes? How does it pass the SEC's market surveillance test? That seems like the biggest hurdle. That is the critical test. It boils down to this SEC requirement. The exchange listing the ETF, like NYSE ARCA, has to show it has ways to prevent fraud and manipulation. Usually this means having a comprehensive surveillance sharing agreement, with a significant regulated market where the underlying asset trades.
Like futures markets.
Exactly. For Bitcoin and Ethereum, Grayscale successfully argued that the CME futures market was that regulated market. It was big enough, liquid enough, regulated enough to provide reliable price discovery and detect manipulation.
Okay, but DOGE doesn't have a CME futures market like that.
Correct. DOGE doesn't have that same kind of robust, regulated futures market, so Grayscale's argument has to pivot. They can't use that playbook. They're likely arguing something different. Maybe that DOGE's sheer trading volume and its decentralized nature across many different liquid exchanges actually makes it hard to manipulate on a grand scale.
Interesting angle. Decentralization as a feature against manipulation.
Kind of. They'll point to metrics, maybe the large number of active addresses, the high velocity of transactions, the fact that its market cap, while volatile, has been sustained for years now. They need to frame it as less of a fleeting pump and dump and more of a persistent, culturally backed asset. They have to convince the SEC that the current market structure is inherently resistant to centralized control, even without a single dominant regulated futures market.
So it's an argument built on sustained cultural presence rather than, say, technical utility alone.
Largely, yes.
But doesn't that still leave the Musk factor? The fact that DOG's price has historically jumped or crashed based on tweaks from one or two very public figures, isn't Grayscale risking its serious institution reputation by backing something so whimsical?
That's the tightrope they're walking. It's a calculated risk. They're betting that the potential revenue and the first-mover advantage in capturing the DOGE market are worth the potential reputational hit. They're probably calculating that institutional investors are getting more pragmatic. If there's a massive addressable market with clear retail demand, institutions will want a regulated way in. Grayscale just needs to provide the cleanest possible conduit.
So frame it carefully.
Exactly. Frame it correctly. Not as invest in DOGE for its amazing tech, but as here's a regulated vehicle for speculative exposure to a major cultural momentum asset. Compliance folks might still grumble, but the lure of capturing fees often wins out as long as the legal boxes are ticked.
And if we were tracking this analytically, what would we watch?
From an analytical view, supporting Grayscale's case would involve looking closely at DOGE on-chain metrics. You'd want to see how many active addresses are there really? Is there consistent use for small payments or tipping? Or does activity only spike during meme rallies? You'd also analyze whale concentration. Is the supply held by just a few big players? That weakens the anti-manipulation argument. Transaction volume, network fees, anything that shows underlying network health versus just speculative noise on exchanges.
So the more real use, however small they can show, the harder it is for the SEC to just dismiss it as frivolous.
Precisely. It strengthens the case that it's more than just a joke.
Okay, let's pivot now from the wild frontier of Dogecoin back to the more established institutional core, Ethereum. Grayscale's focus here is totally different. It's optimization. These Ethereum trust modifications requested via NYSE Arca, they're less about creating something new and much more about perfecting an existing machine.
That's right.
And we have to start with the backstory, the reason why this optimization is so important. The original Grayscale Bitcoin Trust, GBTC, that trust was the pioneer. It gathered incredible assets, but it also became this huge case study in, well, structural problems and investor pain. Can you just remind us quickly what the core flaw was, the one Grayscale is desperately trying to avoid with Ethereum?
Absolutely. The fundamental issue at GBTC before it finally converted to an ETF was its structure as a closed-end trust. What that meant was, while Grayscale could create new shares and sell them in private placements to accredited investors, those investors and later public market buyers could not simply redeem their shares for the underlying Bitcoin held by the trust.
They were locked in.
Essentially locked in, yes. The only way out was to sell your GBTC share to someone else on the secondary market, like the OTCQX. This lack of a redemption mechanism, that's the key difference between a closed-end trust and a proper ETF structure. Because there was no way to redeem shares for the underlying asset, the share price could, and often did, drift wildly away from the actual net asset value, NAV, the real market value of the Bitcoin the trust held per share.
And that drift became a huge problem.
A massive problem, especially when market sentiment cooled off. GBTC started trading at a huge discount to its NAV. At its worst point, that discount hit almost 48%.
48%. So you owned a share that represented, say, $100 worth of Bitcoin, but you could only sell it for maybe $52.
Exactly. Investors were holding shares worth nearly half the value of the Bitcoin they represented purely because the trust structure lacked that mechanism to enforce price parity. It was incredibly frustrating for holders.
Okay, that's a nightmare scenario they definitely want to avoid repeating. So these current ETH trust modifications, the goal is to fix that internal plumbing before the conversion happens, to prevent that kind of discount gap.
Precisely. They're requesting changes that pave the way for smooth, pre-approved redemptions once the spot ETF structure is fully active. This involves tweaking governance rules, updating custody agreements, but most importantly, changing the operational language around how the trust interacts with its authorized participants, or APs.
And the APs are key here.
They are the linchpin for ETFs. APs are typically large financial institutions, market makers, high-frequency trading firms. Their whole business model, in this context, relies on arbitrage. In a functioning ETF, if the share price drifts away from the NAV, the APs jump in. If shares trade at a discount, APs buy the cheap shares in the market, simultaneously redeem them with the issuer for the underlying ETH, which is worth more, and pocket the difference. This buying pressure pushes the share price back up towards NAV.
And if it trades at a premium.
Same process, reversed. ATs deposit ETH with the issuer to create new shares, sell those premium price shares on the market, and capture the spread. The selling pressure pushes the price back down. It's a constant balancing act. The modifications Grayscale wants are about building and testing that arbitrage bridge now, making sure the plumbing works perfectly so that the moment the ETH trust converts to a spot ETF, that arbitrage mechanism kicks in flawlessly and keeps the price tightly tethered to NAV.
Okay, so when you talk about the main benefit for ETH investors being reduced tracking error, this efficient arbitrage mechanism is the technical reason why. Can you maybe explain tracking error simply for someone learning?
Sure. Tracking error is just a measure of how well an investment product like an ETF or a trust actually follows the price of the underlying asset it's supposed to track. Ideally, for a simple spot ETF, you want that error to be virtually zero. Because of those structural flaws in the old closed-end GBTC, its tracking error was enormous at times. The share price reflected sentiment about the trust itself, the discount, the lockup, as much as, or sometimes more than, the actual price of Bitcoin.
So it wasn't a pure Bitcoin bet.
Not always, no. By improving the operational efficiency now for the Ethereum trusts, Grayscale aims to minimize that tracking error for the eventual ETH ETF. It means when you buy a share of the Grayscale Ethereum ETF, you'll have much higher confidence that you're paying very close to the real current market price of Ethereum. It makes it a fairer, more transparent investment vehicle.
And this whole effort, it really solidifies Ethereum's position institutionally, doesn't it? The 2025 Ether ETF approval was the big legitimization step.
That was the main event, yes.
But these modifications are like reinforcing the foundation, making it truly institutional grade.
Absolutely. They're sending a clear message to the market. We're not just slacking a crypto label on an old structure. We're building financial infrastructure that meets the highest standards of efficiency that institutions expect. This is critical if you want to attract the really big, cautious pools of capital, think pension funds, endowments. They care deeply about stability, predictable pricing, low operational costs. This reinforces the narrative that Ethereum is ready for prime time, an institutional-grade asset built for serious scale.
But there's a patience-required element here too, right?
Yes, we need to add a dose of realism. The source materials do point out that these modifications, while necessary, involve complex legal and operational adjustments. Getting regulatory sign-off, getting everything implemented, it could take months before investors really feel the tangible benefits like tighter tracking or potentially lower fees down the line. It's not like flipping a switch. It's careful re-engineering of the financial plumbing, and that takes time.
Okay, let's zoom out now to the big picture. These two filings together, the ambitious Dogecoin S1 and the meticulous Ethereum optimization, you have to see them as a major signal, right, about broader shifts in the regulatory environment. Grayscale pushing something like Dogecoin so persistently, it suggests they feel more confident that regulators are getting, maybe not comfortable, but more accustomed to assets beyond just Bitcoin and Ether.
The ground has shifted.
The precedent is set. It feels like we're actually seeing that ETF domino effect people talked about starting to happen.
Yeah, and if we trace that domino effect, think about what happens if the DOGE ETF actually gets approved. That would be like the first real crack in the dam for altcoins beyond ETH. It significantly lowers the implied bar for what kind of asset might be deemed acceptable for an ETF wrapper if DOGE gets through.
Then why not?
Exactly. It immediately signals that other established altcoins, ones with big market caps, deep liquidity, maybe even a clearer utility story than Dogecoin, will likely jump in and push for their own ETFs. And the source material we looked at is pretty explicit about who the likely next candidates are, the ones waiting in the wings.
Who are they mentioning?
We're talking about names like Solana, SOL, Cardano, ADA, and XRP. These are already huge assets in terms of liquidity and market attention.
Okay, but even if DOGE clears the meme coin hurdle, these others, they face their own challenges, don't they? It's not automatic.
Oh, definitely not automatic. The regulatory hurdles just shift. If the SEC accepts Dogecoin, maybe focusing on its decentralized launch and market size.
Then for Solana or Cardano, what's the issue? Solana especially has a strong utility argument with all the DeFi and NFT activity on its chain.
For assets like Solana or Cardano, the regulatory spotlight immediately swings to different issues, primarily decentralization and securities classification. Is Solana, for example, sufficiently decentralized now to avoid being labeled an unregistered security by the SEC? That's a massive, ongoing legal question mark. They'll also face intense scrutiny over their proof-of-stake consensus mechanisms, their governance structures.
Who's really in control?
Right. The SEC will demand proof that these networks aren't effectively controlled by a small group of insiders, foundations, or large VCs. And then you have XRP. Its regulatory challenge is deeply tied to its history, those long-standing legal fights about its initial distribution, and whether that constituted an unregistered securities offering.
So DOGE actually avoids some of that because of how it started.
In a way, yes. DOGE's truly decentralized, almost accidental community launch helps it sidestep some of the securities law arguments that plague assets like XRP. So even if DOGE gets approved, each potential altcoin candidate after that faces its own unique, complex legal gauntlet based on its specific origins and structure.
It sounds as institutional money isn't just waiting for the next coin, but for the next clear regulatory pathway for different types of coins.
That's a great way to put it. And we can kind of visualize this potential shift using the idea of an altcoin dominance chart.
Explain that.
Altcoin dominance, or alt dominance, just measures what percentage of the total crypto market cap is held by cryptocurrencies other than Bitcoin. If these new regulated on-ramps get built, first maybe DOGE, then perhaps SOL or ADA ETFs, you'd expect to see a significant capital rotation. Institutional money that's currently sitting on the sidelines in traditional assets, or maybe only allocated to regulated BTC and ETH funds, suddenly gets a green light to diversify within the altcoin space through regulated products.
It validates those ecosystems.
Completely. It wouldn't just pump the price of the specific altcoin that gets an ETF. It could reshape the whole market cap distribution, drawing potentially billions of new, sticky institutional dollars into the broader altcoin market. And importantly, having these ETFs legitimizes the underlying asset in the eyes of, say, corporate treasurers or large financial firms. They might then feel more comfortable exploring related DeFi products built on those chains, like institutional lending pools on Solana, for example.
Right, so the capital doesn't just park in the ETF shares. It potentially spills over. More ETFs mean more official, vetted on-ramps for traditional money into the entire Web3 ecosystem.
Exactly.
Think about that spillover. If institutional money flows into a regulated Solana ETF, it implicitly validates the security, the potential, the infrastructure of the Solana network itself. That could then fuel development and liquidity in areas next door, things like institutional DeFi, lending and borrowing protocols designed specifically for regulated players. Maybe even more institutional interest in high-value NFTs or digital collectibles issued on those chains.
Wall Street could be using these ETFs as strategic beachheads, efficient ways to deploy capital deeper into decentralized finance and application layers over time.
So let's try to synthesize this big picture then. What are we really witnessing here?
I think what we're seeing is this fascinating convergence of internet culture and sophisticated financial engineering. Dogecoin, the ultimate viral phenomenon, is being sort of forced through the institutional pipeline, potentially transitioning into a recognized financial instrument. And this forces Wall Street to confront a new reality where cultural credibility and massive retail engagement can actually translate into viable financial products if the infrastructure, like Grayscale's optimized trusts for ETH, is robust enough to handle the scale and complexity.
So the dual strategy makes sense in that context?
Yeah, absolutely. Optimizing ETH ensures they dominate the established blue-chip crypto asset class with structural perfection. Pioneering DOGE is their attempt to capture the lucrative, highly volatile, retail-driven speculation market within a regulated wrapper. It's reading the regulatory tea leaves, seeing the potential for expansion, and positioning themselves for maximum growth across the entire digital asset spectrum. It's aggressive, it's analytical, and surprisingly, it's quite cohesive when you look at it that way. Hashtag tag outro.
Well, that was definitely a deep dive into Grayscale's strategic playbook. A lot to unpack there. We covered their dual commitment, right?
Right.
On one side, meticulously optimizing Ethereum for institutional efficiency, clearly learning from those painful lessons of the, what was it, 48% GBTC.
Or the 50%, yeah. Painful lesson.
And on the other side, this really ambitious, maybe precedent-setting push for the first ever meme coin ETF with Dogecoin. The big regulatory signal seems clear. The ETF frontier is pushing out, expanding beyond just Bitcoin and Ethereum. And it's being driven not just by tech or utility, but also by sustained cultural hype and market liquidity. So what does this all mean? I guess it means the very definition of an institutional asset is broadening, maybe faster than we thought. And Wall Street seems ready, even eager, to meet retail investors wherever the action and the potential fees are hottest.
Which leaves us with maybe one final provocative thought for you, the listener, to chew on. Considering the very real risks tied to DOGE, its speculative nature, its history driven by, external social media hype, do Grayscale's efforts, these revised filings, this significant investment, does it truly reflect deep institutional conviction in Dogecoin's long-term value or technology? Or is Wall Street simply building the most efficient, regulated pipe possible to tap into that massive existing retail demand and meme energy, positioning the ETF more as a sophisticated tool for channeling speculation rather than a traditional investment product based on fundamentals?
Capturing liquidity versus actual belief.
It's a fine line, and where you draw that line probably says a lot about how you view Dogecoin's future and maybe Wall Street's motives too.
Definitely something to think about.
Yeah.
Thank you for joining us for the deep dive.